Good evening, traders. Chris Buss here with Traders Profit Compass with a closing market wrap for Wednesday, May 11th. It is 6:51 p.m. as I'm starting the video. And as always, please run your player at 1.5x. So today we got the CPI number. Came in a little hotter than expected. One of the things people took note of was the what is it called, the average equivalent rent number. That is a number that historically takes a long time to get into CPI, and that's the average. It's the average equivalent rent, I'm sorry. So that takes in account the housing prices and the rent people pay if they're renting, and that number takes a long time to work its way into CPI, and it started really showing up this time. And what I think you're going to see is, although goods inflation may drop in the coming months, I think that housing equivalent rent is going to stay really, really sticky for quite a while. Now that the longer it takes to work its way into that CPI, the longer it takes to come out as well. So there's a delay. So I think that portends a sticky CPI through the summer, I think, and I don't think there's going to be a big window for the Fed to back off immediately. So I think they're still on course to stay on their tightening cycle and QT and all that stuff we've been talking about, pulling liquidity out of the system. So let's dive into the charts. I think you'll find some interesting things in what I want to share with you tonight. Get some thoughts together for facing the market tomorrow. Here's my extremometer. This is the put to call ratio. Below the green line is excessive put buying. Above the red line is excessive call buying. And you can see here that today they're actually buying calls. We're above not excessively, we're not above the red line, but you can see that this we really have not had a big plunge or a big spike in put buying, and today they're actually buying calls. Now, the only thing that I can imagine is people trying to pick a bottom, and I think that's a losing strategy right here, just for the simple fact that price keeps going down, and until price can reclaim some of the levels above, I think you have to, go with price at this point. Now, there's a lot of other information I want to share, so let's move on. Here's the NASDAQ McClellan oscillator down at 69. Normally, I would be saying rotate out of all your puts. Why? Because the rubber band is stretched. Let's take a look at the stretch to the downside, where you can see the risk reward for staying short is getting diminished, where minus 90 is about the max level, and except for these extreme conditions like we had back in COVID. Same situation on the NYMO. We're down at minus 68. But here's what I want to say. This thing is spring-loaded in two directions. What do I mean by that? Well, you can all remember as kids, you pull that rubber band back. You really want to nail some kid, in the classroom. You pull that rubber band back, you pull it back, you pull it back. You really want to make a great shot, and the rubber band breaks. And so we've been talking about, we haven't had that real capitulation sell-off, and that doesn't mean we have to by any means. So let me make myself clear. With the rubber band stretched to the downside, one of two things is going to happen. There's going to be a violent sell-off. That's when the rubber band breaks and all bets are off. Or there's going to be a snapback rebound that could be quite dramatic. Here's the VIX. I mean, really didn't do anything today. Actually, this is for the week. Let me see if I can find a daily down here somewhere. VIX daily. Here we go. Actually, down on the day, down 1.3%. Not taking out this 36 level that we've been talking about. One of the reasons that I heard today that kind of makes some sense is the big money institutions have already de-risked so much that they don't have relatively as much to protect by buying those puts. So that may be suppressing the put buying, and so this may not be, we may not get that super spike that I've been personally been looking for, but it remains to be seen. So I would still have that 36 level, 36, 37 highlighted on your chart. And I can tell you that since I've put the VIX, into my matrix where it's visible like a chart, not just like on the side in my, sidebar list, it's been really, really helpful as far as navigating all these rips and dips that we've had. So if you haven't done that, I think that would be a real good idea. A lot of the drama over the last few days has been Bitcoin. I'm sure you've heard that that Luna stable coin that's supposed to be pegged at $1 is trading like at 50 cents. And there's a real worry out there that, in crypto land of contagion, that it's gonna race through, all the different coins, and like it already has. I mean, we've gone from 38,000 where we marked this trend line, and we said, you got to get out at that point if you're a long guy, and if you're actively trading Bitcoin. That was a great entry. You're 10,000 to the good in just a few days. Here it is on the weekly chart that we showed the other day, and here you can see we're breaking below this big uptrend line off of the 2019 lows, and now we've broken that. So Bitcoin has got a lot of work to do just to kind of get back to neutral. And I would think, one, it's got to recover this trend line, but two, it's really got to get over 35,000 to have any kind of air of confidence at all. And you can see how far below the 40-week exponential moving average, which is really the demarcation line between a bull and a bear market on the weekly chart, same as the 200 on a daily chart. And you can see just the momentum and the RSI coming way out of this. And I just don't think there's a lot of appetite at this juncture to get long Bitcoin. And you can see in the chart the massive void that goes all the way down to 12,500. And I want to throw this out there because it was something that I've been thinking about. You remember the CEO at Valiant, the Canadian drug company that was all the rage? I don't know what it was, 2013, 2014, something like that. Well, it became known that he had borrowed against a ton of his stock. And so once everybody knew that, the world conspired to want him to see a margin call, which they eventually did, and then the company blew up. Fast forward to Bill Ackman with Herbalife. He got in this 5-year battle, making a big noise that Herbalife was a fraud and that he had $1 billion short on it. And he got in this big pissing match with Carl Icahn. I'm sure you remember that. But again, everybody and his brother knew he was short. So what did they do? They squeezed him out. So now everybody and their brother knows that this Michael Saylor from MicroStrategy basically has his whole company levered to Bitcoin, and he gets a margin call at 21,000 on Bitcoin. Well, what's going to happen with that? Is everybody and their brother want to sell Bitcoin until Michael Saylor has his margin call and has to capitulate? I'm just saying. And there's no grand strategy. Everybody acts independently, so I don't want this to sound like, everybody gets on the phone and says, let's short Bitcoin so Michael Saylor has a margin call, but it turns out that way. Also, remember that Melvin Capital, that everybody knew, all the Reddit crowd knew that Melvin Capital was short GameStop. So what happened? Everybody squeezed them out. They ripped it higher and forced that company to cover, and that company had to go out and raise capital just to stay alive. So there's another example. When everybody knows what you're doing, then everybody wants to see you fail. So they go after you and they see you as a ripe target. So watch Bitcoin. That'll be the drama that unfolds. I'm not in it, so I'm not talking my book. I don't want to see anybody, think that when Bitcoin gets down to 22,000 next week or tomorrow, that it's some screaming deal. Because in this chart, you can see the massive void, and I think it's coming back here to 13,000. That's not going to be in a straight line. It's going to do this and do that, but that's where it shows on the chart. As long as this thing is below 35,000, I think it's going lower. And I think you can use Bitcoin as a barometer for the Qs and vice versa. You overlay the charts, it's remarkable. It's a liquidity proxy, and when Bitcoin is going down 16% in a week, it's going to be real hard for the Qs to go up, just as a proxy for liquidity. So let's move on to SPY. Here we are on the weekly. We've clearly broken support here at 410. Our 38% retracement is 375. That's also where this larger volume over price bar comes in. So I would be looking for weekly support in this 380 area. And remember, on a complete snap of the rubber band, all bets are off. I mean, it could, be there tomorrow. I mean, we're already at 392. So, 380, 375 is nothing, especially on a weekly chart. So that could be down there in a flash. Here it is on the daily chart. You can see we had a reach back early in the morning where the market initially took that CPI information as bullish, ramped it up to 405, and that's exactly where it failed. It was at, remember we talk about these breakdown candle highs. Well, we had a big breakdown candle, what was that, Monday at 405. Yesterday, we could not take it out, and today, we could not take it out either. So check mark for the bears on that one. Now tomorrow, I think you got to have, remember, with each successive level that you break, then that becomes a level that's in the crosshairs to be recovered by the bulls. So let's look at it on an hourly chart. And I apologize, the stock charts is, it just, tomorrow it'll recalibrate, but for now, we're down here in the lower right-hand corner. So we broke through 395. That was yesterday's low. You see that right here. So we closed on the dead lows, and we took out yesterday's lows. So check mark for the bears. Tomorrow, be on guard for a recapture of 395. And what I wanted to point out on this chart is a couple things. Notice bullish divergence on RSI. We're printing lower lows, but yet the RSI is printing higher lows. Same thing with momentum on PPO. Higher low, lower low in price. And you can see that I've dropped in a declining trend line, making this bullish falling wedge. You get a breakout above 395, you got to be on guard for a quick move up to 400. And if you didn't cover any of your shorts, start unwinding at 395. I would say on a recapture of 400, you got to be out. Why? Because you've got this, steep falling wedge. You will have recovered 395, and 400 would be the demarcation line for a breakout in price, not only on a recapture of 400, but also a breakout from this falling wedge. And then you could see a flash move up to 405 and possibly even up into this, fill this gap up to 411, right in that area. So have your finger on the trigger on covering your shorts. I'm not saying it's gonna happen. I mean, if the rubber band snaps and we cascade. But if this thing just keeps hanging around with bullish divergence inside this tight little wedge we've got, it would not take much to spark a snapback rally that could be pretty vicious. Because remember, we've got those oscillators extended to the downside, and right now it's almost binary. Either it snaps or it snaps back. I don't think it's going to linger here for a week at minus 70. I think something's going to happen one way or the other. And I can't stress how important it is to be very, very nimble at this juncture. Let's look at the cues on the weekly. clearly broken trend, or excuse me, broken support at 310. I've got a measured move target that aligns really well with this 50% retracement area at 283, and we're also already at 291, so that wouldn't be anything to come down and tag that level in the near future, like tomorrow. Here we are on the daily chart. This measured move target is off of this A, B, C move, and we're already there right now. So I'll throw out another scenario for tomorrow that would be pretty bullish for the bulls. An early morning sell-off, and then they buy it up and jump back above 290. That would be a real warning sign for people holding shorts to cover that and get the F out. You can either step aside, or if you're nimble enough to try a long at that juncture. If we were to go down below and then come back up above, you see I've got a trend line here on the daily chart, and we would have a long ways to go to hit that trend line in the next couple of days, and that is nothing that you probably want to sit through on the short side. Let's look at the 1 hour chart. Again, you've got some bullish divergence here, not as much as on the SPY, but you do have it. Higher lows in RSI while price is falling, and momentum really hasn't burned completely through the bullish divergence that's present on the PPO. I mean, there's not much there, don't get me wrong. If this thing just rolls over here, it will have, and takes out this low for sure, then you've burned through that divergence. And you may even burn through the RSI divergence, if we go down here and take out this low back here in RSI. But let's look at this chart. We're sitting right here, closing on the lows. You can see that that's the bottom side of the channel. Just the other day, we popped up to test the midpoint of the channel and got rejected. That could very easily happen, tomorrow as well. I would be keying in on this 297.50 area. If they were able to pop that, then you'd go right up to this 305, which I think we noted from this morning and yesterday. You can see here rejection, rejection, rejection. So that 305 is going to be like your fail-safe line on your shorts. You break above 305, you got almost, first stop would be 310 at these lows. You pop 310, you're going to 317, 322 type area for that big test. And the thing I wanted to point out is, I didn't draw it in here, but you can see this wedge forming here. If I were to draw a line from here, catch these high points, you'd see that was a wedge as well. So those are really powerful formations if the bulls can pop it. And what I was going to say is, it would be nothing, absolutely nothing, for a vicious bear market rally to come up to test this 317 area. And that's what is that? It's $20, right? at least. $27. Is that $27? 290 to 317. Yeah, that's like $27. I mean, if you're nimble, that could be something that you want to participate in. Weekly IWM. This thing is, I think, almost done for now. You've got the pre-COVID highs here at 165. If you were short, I would be hitting the eject button if we got to 165 and the rubber band hasn't snapped. If it snaps, you could go below, but if it hasn't snapped and you got down to 165, if you wanted to stay short, I would definitely be rolling down. And I will tell you, today there was $33 million of IWM put premiums sold today. So what that tells you, remember the put selling strategy that we talked about? They were doing that big time today. One of the biggest guys that I saw was selling the June 175, 165, and collecting $4 for that. I did that 24,000 times. That's not a trade I want to make. I would never, sell that in the money. But if we get a flush down here and we get some bottom signals, I would be interested in selling, like even just for May, for a week, selling, a 160, 150 for whatever that was worth, because premiums are going to be jacked. And just even the littlest of bounces, those put spreads would become almost worthless, which is, of course, what you're looking for. Here we are, IWM, going to pick up the pace here a little bit. We've got a gap down here at 167. That lines up really well with that 165 we were showing on the weekly chart a minute ago. What would be really bullish? Come down, fill that gap, hold, and then reverse. So that would be something to look for. IWM, bullish divergence again on RSI. Got this big wedge again. This formation here on the 60-minute chart. I think you got to be out of any IWM shorts on a breakout above 176. That would break you out of the wedge and send you on a course probably up here to 180, if not 183 type area. So I would be keying in on 176 tomorrow on any kind of a upside breakout. I told you about Facebook today, moving inside this monster gap. I did take a position right in here. I was fortunate. If you look at a 5-minute chart, you could see that it stalled right here. I got out of it. It recycled up to the top of the gap entry. Breakdown, back test, fail. So I was able to recycle in. I'm in May. I forget the strikes, but May puts. See what happens. I think this thing only fills quickly on a rubber band snap scenario. You can see that there was this trading range back here that might provide some support in this 187 area. But if it breaks that, then I think you're going to get a quick move to 180 inside this big gap. I think one of the biggest things that happened today was Apple broke. We had flagged Apple on this triple support here, the 200, 157.50, and the uptrend line. That broke in a big way today, down 5%, where the NASDAQ was down 3%. You don't see that every day. Why? Because Now I think Apple is becoming a source of funds. And remember, everybody and their brother who is in a passive fund of any kind, Apple is going to be one of their biggest holdings. I mean, doesn't matter if it's Vanguard or the QQQs or Growth or however you want to slice it or dice it, Apple is going to be one of your biggest holdings. And for retail, one of the biggest individual holdings that are out there. So when you see Apple start leading to the downside, watch out, because it's the biggest weighting in SPY and it's the biggest weighting in QQQ. And now it is definitely on the wrong side of the charts. I was short. As it came in to this large volume over price bar here at 145, I closed it late in the day. And then what I did was I bought a May 146, 140 put spread. Not big at all. Just to have something in it if the rubber band breaks. And the reason I spread it, if there's a snapback rally, that spread is not going to hurt nearly as bad as just having naked puts. So I was able to get that for $1.85, $2, something like that. So $6 wide for a 3-to-1 risk-reward ratio with these elevated premiums. I thought that was pretty good. We'll see if it works, but that was a great trade. Breaking 157 and then getting a fast move all the way down to 145. Tesla, bad day at the office, 8%. Broke this 800 level again. Yesterday, could not get above this breakdown candle high. When it broke the low today, that was the green light, straight down. And again, I'll say it because I'm thinking about it. Now with this Twitter thing, with Elon got a lot of his Tesla shares pledged for this thing, for Twitter. Everybody knows there's some level, I don't know what that level is, but at some level, Elon's going to get a margin call. And there may be a lot of people out there that don't want him to get Twitter. And if the value of his Tesla shares, if the rug gets pulled out in a big way, and he can't find other investors, maybe he walks away. I have no idea. All I know is the whole world knows that Elon has a margin call out there at a certain level, and the chart couldn't look more bearish. I think the next stop is a big test at 700 at this February low. You break 700, God knows where it might go. So we'll cross that bridge when and if we get to it. Bad day for Microsoft, down over 3%. Lost the low from the other day. Down here towards 260. Let's look at the weekly chart real quick. We are right on the line. Right on this 38% retracement level. You lose 260. 240 comes up real fast. So keep your eye on Microsoft. Amazon, talk about a liquidation. My gosh, I haven't been trading this, but oh my gosh, if you have, congratulations. Let me know about it. I'd love to hear about it. But here we are, coming in on the pre-COVID high with a little gap to fill. If you've been riding this thing down, I would be looking to pull the ripcord right in this 2050 area, something like that. If the rubber band breaks and all hell is breaking loose, that's a game time decision. It could, slice right through that. What I would be doing is, you've got this big trading range. What I would be doing is recalibrating around that 2050. Take whatever big wins you have off the table. If it breaks down below 2050 and the world is ending, recalibrate around that level, and then you can stay short against 2050 after this gap has filled. That's what I would do. Google, the selling's abating right here at this 38% level. If you've been riding it short, I would consider getting out of that at this point. What I wanted to show you is the 60-minute chart. You can see it really well. Look, everything was down 3% today, plus Google less than 1%, outperforming in a big way. Notice here that this 2250 level has held like a champ so far. I would not do anything with this unless and until this 2250 broke, and that would probably be with a rubber band snap break. And so, if anything, this sets up for a great long. If everything else is falling 3% and this thing has stopped going down, the selling might be done for that name. Can't say the same for Netflix, down 6%, just working its way down. I've already shared my views on that quite a bit. Semis lost this 223, and that was a big level. Let me show you the weekly real quick. Here's a break on the weekly. Massive void below. If you wanted to take a shot, try a 220 put with, a 223.5 stop. And if this thing lets go, you could be down at 205 in a flash. And if the world ends, 180. Not saying that's going to happen, in the next few days. But all I'm saying is, once we're below this 223, the chart will not look bullish until that level is recovered. And if there's a lot of pronounced selling going on, you've got a great line to shoot against at 223. I'm not going to spend a lot of time on ARC, but every day, 7, 8, 10% down. ARC FinTech, let go 10%. Genomics, down 9%, letting go. ARC K, 10%, letting go. If you overlay the Tesla chart on this, it's almost the same chart, just with a different scale. So what I've been doing is I watch Tesla all day long. I don't trade it. I trade ARC. And what can I say? It's been doing great. Got shaken out of my position on this kickback. That was like 20% in a couple days. Enough, it put the fear of God in me. Proved to be misplaced because now it rolled over. But stay flexible. I got right back in and down we go. ARC W, 11%. Same kind of pattern. And here's what I want to say kind of about how I approach it. In this kind of market, you got to stay really nimble and really focused. And it's really easy to be sitting there. Oh my God, Upstart's down 40%, and Coinbase is falling apart, and oh my God, Palantir, and oh my God, Datadog, and oh my God, everything, throw a dart kind of thing, it's going down. If you're not careful, you're going to have 35 positions short, and when that snapback rally comes, you're going to be going crazy. So I have a pretty narrow bandwidth to begin with. I probably have more positions than I should at times, but I try to keep it focused. I'm focused on the indexes. I am focused on FATMAAN. I am focused on ARC. There's a few other little stragglers in there, small positions, more or less just they're there and I grabbed them, but very small. My meat and potatoes, especially in down markets like this, is, focus on 10 or 12 tickers. That's about all I can handle. And as long as ARC is outperforming to the downside, as long as the indexes are doing what I want them to do, as long as I can take some, good positions in Facebook and Microsoft and Apple and watch Tesla for ARC. I mean, how much more can you really focus on than that? And so if you feel yourself getting a little discombobulated, narrow your focus, keep your bandwidth in your comfort range, and then just do a good job on the tickers that you're trading, and you're going to do just fine. That's a lot better than Coinbase today, Palantir tomorrow, Upstart the day after that. If you got some of those, great. But all I'm saying is, if you feel like it's getting away from you, and especially now where this thing could literally go either way in a big way, you don't want to get caught on the wrong side of that with a ton of positions, and when that thing snaps back, you literally can't close them fast enough before you get clipped pretty bad. So be careful. Trade within your skill set. Trade within your bandwidth. And by all means, watch those levels like a hawk. They mean everything in this market. And one last thing. Valuations and fundamentals mean zero. Absolutely zero. I'm not a fundamental trader, but so they pretty much mean zero to me any day of the week. But there's a case for it. I mean, for valuations and all that kind of stuff. When you're trying to size up markets, if that's your thing, by all means, lean on them. I don't mean to disparage fundamentals, but in a bear market, liquidation type of a scenario, it doesn't matter what it is. Could be the best company in the world, like Apple. When it lets go, it lets go. And you can talk about, the PE as much as you want. It's not going to matter. And that's why if you wanted to do something for fun, fade the pop on any kind of earnings. If they pop up 5%, it's free money because they're going to fade it. Those gains are not going to hold. So be really careful. If fundamentals are a big part of your process, they're a smaller part of your process in this kind of market. Let's wrap it up there. I hope you got something out of it. I hope it prepares you well for tomorrow. If there's anything overnight, I'll certainly touch base with you in the morning. In fact, I'll do that either way, kind of fine-tune this thing tomorrow after overnight futures. This has been Chris Buss with Traders Profit Compass. Talk to you next time.